Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Viking Therapeutics Inc. quarterly report. Viking Therapeutics Inc. offers a range of innovative treatments for various metabolic and endocrine disorders. Their services include development of VK2809, an orally available thyroid hormone receptor beta agonist for non-alcoholic steatohepatitis, NASH, and NAFLD treatment of patients recovering from non-elective hip fracture surgery with VK5211, a selective androgen receptor modulator management of type 2 diabetes with VK612, an orally available drug candidate research and development of VK2735, a dual agonist of the glucagon-like peptide for various applications treatment of X-linked adrenoleukodystrophy with VK114, an orally available thyroid hormone receptor beta agonist. Viking Therapeutics stock price crash. A year of decline. Viking Therapeutics Inc. VKTX has experienced a significant decline in its stock price over the past year, plummeting by -53.63%. Several key events have contributed to this substantial downturn. The company's oral obesity candidate, VK2735, faced concerns regarding its safety profile and tolerability after clinical trial results were released. Additionally, manufacturing difficulties and associated costs for the same drug raised concerns in November 2024. The company's net loss widened in Q3 2025 due to increased research and development expenses, leading to a stock price drop of 4.73%. Analyst expectations of a significant drop in earnings per share also contributed to the decline. The cumulative effect of these events has led to Viking Therapeutics' stock price crashing by over 53% in the past year. The company's future prospects are now under scrutiny as investors remain concerned about its ability to overcome these challenges and achieve success in the market. The primary drivers of revenue growth for a company are multifaceted. Collaborative research and licensing agreements can generate significant upfront fees, research funding, and royalties. Regulatory approval and commercialization of drug candidates or collaborative agreements with third parties also contribute to revenue growth. Additionally, proceeds from the issuance of common stock and potential future revenue from ATM offerings can provide a boost. On the other hand, several factors can lead to revenue decline. The loss of license to key technologies, failure to obtain regulatory approval for drug candidates, and competition from other companies with approved products are significant concerns. Delays in completing clinical trials, limited experience in conducting trials, and undesirable side effects of drug candidates can also hinder revenue growth. Furthermore, changes in tariffs, trade barriers, price and exchange controls, and supply chain disruptions can impact the company's ability to generate revenue. Net income has consistently decreased throughout various periods, primarily due to significant research and development expenses, manufacturing failures, regulatory compliance issues, reductions in Medicare payments, higher tax liabilities, and one-time tax charges. Profit margins have also been negatively impacted by high costs associated with clinical trials, potential delays in clinical development or regulatory approval, remedial measures for noncompliance, temporary or permanent closure of facilities, reduced reimbursement from government programs, increased transparency requirements for drug pricing, and potential changes to the Medicare drug price negotiation program. These factors have contributed to a decline in both net income and profit margins over time. The company's financial performance indicates a concerning trend in its ability to generate positive operating cash flow. Despite the lack of specific details, the extracted summary reveals that the company has experienced negative operating cash flow for both 2024 and 2025. This suggests that the company is struggling to convert its revenues into actual cash, which can be a sign of underlying financial issues. The company's financial situation has undergone significant changes in recent years. The total debt level appears to be inconsistent, with a decrease reported on page 1 but an increase on page 22. However, it is clear that interest expenses have not changed significantly, remaining relatively stable at $26 and $27 for the respective years. A notable exception is the operating lease expenses, which have increased by $26,000 in the 3 months ended September 30, 2025, and by $98,000 in the 9 months ended September 30, 2025. This increase suggests that the company's interest expenses may be rising, despite the stable overall figures. Management's outlook on company strategy. According to recent summaries, management expects significant operating losses in the next stages of corporate development. They anticipate increased research and development expenses as they advance their drug candidates. The company also faces challenges from regulatory changes, including reduced Medicare funding and more rigorous coverage criteria. Additionally, management is concerned about compliance with healthcare laws and regulations, data protection issues, and employee/consultant misconduct. They acknowledge the importance of prioritizing sustainability and responding to changing expectations on corporate responsibility. Management's strategy appears to focus on advancing their drug candidates while navigating a rapidly changing healthcare landscape. However, they also highlight potential risks such as tax liabilities, intellectual property protection, and market price fluctuations. Overall, management is cautious about the company's ability to generate revenue and comply with regulatory requirements. The company has made significant investments through acquisitions and divestitures in the past year. Key acquisitions include the purchase of $976.4 million worth of investments within a 9-month period. Additionally, the company has acquired companies, assets, products, drug candidates, and technologies to enhance its portfolio. It has also entered into collaboration agreements with academic institutions to accelerate development of new drugs. Furthermore, the company has in-licensed intellectual property rights from third parties to expand its capabilities. On the other hand, the company has divested certain assets or spun off some operations, as mentioned on page 68. These transactions aim to optimize the company's portfolio and focus on core business areas. The company has a history of buying back shares. Notable instances include repurchasing 633,810 shares in May 2015 and 729,034 shares from March 18, 2022 to March 18, 2024 under the prior repurchase program. Additionally, a new repurchase program was authorized in February 2025 with a budget of up to $250 million over 2 years, although no shares were repurchased during the quarter ended September 30, 2025. Concerns about inventory buildup or supply chain disruption are valid. Multiple factors contribute to these risks, including inventory buildup, potential for third-party manufacturers to fail in providing sufficient quantities or quality levels, limited number of suppliers for raw materials, delays in acquiring raw materials, supply chain disruption, failure to obtain adequate raw materials, performance failure on the part of manufacturers, suppliers, or vendors could delay clinical development or regulatory approval, complexity and time-consuming nature of collaboration arrangements, risk of supplier failure and inability to secure replacement suppliers, disruptions to global supply chains due to geopolitical conflicts and potential trade wars. These risks can lead to increased costs, delays in research activities, and ultimately impact the success of projects. That concludes the financial summary for Viking Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.